Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar in New York. Now, I've said this before, how many things may have changed here over the course of this market's journey, but one thing has been constant, even now, though I'm the first to admit it has been tested as recently as 2 weeks ago. It is the lower time of the December 2020, April 2021 bullish shift pitchfork, currently at 1759, and it is still the core of the bullish support to this market. The April 2020 today uptrend, currently at 1750, and the April 2021 today uptrend, currently at 1743, have both been reassigned as recently as the changeover drop from 2 weeks ago. However, despite the lower time being breached 2 Mondays ago, it was not broken, as was proven by the immediate bullish double on the following Tuesday, the tine repairing itself and making a pipe bottom in the process. The rest of that week, as I've said in a Sugar Week presentation, was spent filling in the substantial gap left behind. In the process of trying to fill in that gap, prices overcame the declining medium moving average, currently at 1839, and over last week, the flatlining long moving average, currently 1867, as well as the downtrend dating from the middle of May, currently 1858. Now, I've kept this downtrend on the daily chart for a reason that soon will become apparent. The market seems now to be stabilizing over the long moving average, the first time it has done so since mid-July, and apparently a better version than the one that we saw then. The bullish incentive is seemingly ever so gradually being exercised here and increased. We now have overhead resistance from the February 2021 high 1894 and the cap that stopped the rise last week, as well as the early April to date downtrend currently at 1901. Beyond these, well, we have limited resistances up to the July high at 1959. Right now, well, we are set to make a daily key reversal today. If prices close over 1884 or under 1881, then we'd be on, if only just. Anything in between, well, that would be a lesser outside week and also an indecisive spinning top. At the moment, we seem to be looking at a daily key reversal up. There's also another highly symbolic pattern in the making. See, we are set, now set, with still 2.5 weeks of October to go to possibly have a monthly key reversal here in New York raw sugar. See, if we close on Monday, the 31st of October, either above 1842 or under 1789, then we'd be on. Anything in between, and we have a lesser outside month pattern. At the moment, we are looking at a monthly key reversal up, possibly. This now brings me to the two main patterns I've been discussing in past commentaries. Firstly, we have the possibility of looking at the action from late July to date as a sideways triangle, with the May to date downtrend, remember that one, being the top trend line and the lower tine acting as the lower trend line. Personally, I originally thought this would be a bit of a stretch, but it is there, and as we've broken higher, it is time to consider some targets on the top side. Primary target X would be in the 20 even area, with secondary harder to achieve target X1 in the 21 even area. Now, before you say, I know these are effectively successive round numbers, all I can say is that is the way they worked out. The second idea is to look at the August to September action as a possible double bottom. There is merit to this idea, and it could work in conjunction with the sideways triangle idea. Again, this is not a great example of such a pattern, but it would give an initial target X2 in the 1963 area and a secondary harder to reach target X4 in the 2005 area, close to original target X. All this is what it looks like right now. Ice Europe white sugar in London. This one is dominated once again, as it was in the previous times, by the changeover gap from mid-September. Now, one can say a lot of things about what happened beforehand, but the changeover gap here on a continuous daily chart is really big. The action stretches from roughly the September 2016 high at 619 down to the 50% Fibonacci line, the July 2021 today action at 522.80, and the congestion seen in early 2017 at 517 80. The actual gap is from 541 even to 603.60, and there has been a number of attempts, initially tepid in September but more active in October to try and fill it. Last week was the most recent effort with closes over the short medium moving average, currently 552.30. Then also the flatlining medium moving average, currently 554.30, and the neckline of the neckline currently at 555.30 of the August to December complex head and shoulders top. Last Wednesday, prices even punched up over the February 2017 high of 565 even, but as yet have not closed over it. What is interesting about all these attempts higher is that the opportunities above, over the February 2017 high, are, how shall I put it, stimulating, I suppose. We have limited congestion dating from September between 517.20, 573.80, and 579.30 and 581.5. But the next significant resistance is the November 2016 high of 589.90. We shall see how this develops. Sugar white premium spread. And there are now 3 salient points to recognize here and 3 salient points to consider. They are all big picture items. First to recognize is how the weekly key reversal down here reached up so high for another week up to the 2013 high at 152.5. That was also over the middle time, currently 150 3/4, the big 2019 to 2021 bullish Andrews pitchfork last week, but did not manage to close over it. The second is how the market opened and closed over the neckline, currently 141.5 of the June 2020 to May 2022 reverse head and shoulders pattern, for the first time since the big changeover of contract in mid-September. The third is a bit dated but still relevant, is how the upper time, currently at 224 3/4 of the recurring big old bullish Andrews pitchfork from 2019 to 2021, managed to capture the top of the market, admittedly after it had been breached, but still capture it and turn it back down within a week into a weekly key reversal down, closing below the middle time of the very same bullish Andrews pitchfork. This is still indicative to me of how this large bullish Andrews pitchfork is still intact, if a little damaged, and has been mending itself. Now, 3 salient points to consider going forward. First, that we have an ascending expanding wedge pattern, which I have highlighted in red trend lines. That has been formed since mid-April, and that's currently between 137.25 and 246 3/4. It is still not the best looking pattern I've ever seen, but it is also still there. And it comes with all the possibilities such a pattern could invoke. The second is the monthly key reversal down we saw in September. Now, take this information with a huge pinch of salt, as the earlier monthly key reversal down we saw in July did not work out so well. So there's a big dose of question marks with this pattern as to whether this has reignited a bearish incentive or not. The third point is twofold, and is to consider the support being given to this market by, firstly, the rising medium moving average, currently at 142 3/4, and then the support of the two 50% Fibonacci lines of the August 21 to September 22 move at 131 1/4, and the July 2019 to September 22 move at 128 3/4. These two 50% Fibonacci lines have been working in conjunction with the medium moving average in thwarting the market in some of its recent attempts lower. These are the salient points to consider going forward, some shorter term and some longer term. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.